We're officially live on YouTube for the Thursday edition of the Not Your Average Investor Show.
Week.
I'm my host, Pablo Gonzalez. With me as always, just being remote today because we're in different parts of the world. The man that I affectionately like to call GC. He's of his genius concepts. He knows how to generate cash flow. Say hello, Gregg.
Hello, everybody. Great to be with you. Pablo, you are screaming so much that I don't even think your mic can keep up with you, brother. So,
am I too loud? Do I need to tone it down?
No, I'm just saying it's not even keeping up with you. Tell your microphone to step up its game to capture the full passion of what you're bringing, brother.
Here we go. Okay, cool. We got another microphone working right now. And our guest investor today, working with us through a couple of technical difficulties here, but he's no stranger to that because he's been in tech sales for the majority of his career. Coming to us here out of Boston, Massachusetts, Kevin O'Brien. Welcome to the show, Kevin.
Yeah, thank you. Great to be here. Appreciate it.
It's good to have you on. You know, Gregg and I talk about it all the time. We get to interact a lot with the folks that join us live, and we love the community that joins live, but we're always real curious about who's using the podcast as a resource. And we love the data point when someone shows up, and we love to share the stage and find out kind of like how you like the audio experience. And one of the questions I have is, do you like the roll call when we're on the podcast? Does it inject energy, or do you like fast forward through it?
I'll be honest. I know it enough. I do fast forward most of the time now, but I enjoy it. I know who all the big people are, like Lee. I'm up to date, but often I jump forward.
I got good news for you. There's no fast forwarding at this time. You're part of it. We're ready for the roll call. We got John Henning, our leadoff hitter, kicking us off today. We got the MVP, Lee Bishop, checking in with a good afternoon, everybody. We got Michael Santorios checking in with a good afternoon. We got our regulars, the second family of the Not Your Average Investor Show from Murrieta, California, Gary and Rosalind Riley checking in. We got Nadeem Shah from the West Coast with his traditional good morning, good afternoon, JWB family. Hope all is doing well. We got Tony D from South Florida saying greetings to the special guest today. Welcome, Kevin. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
Checking in with us from California. Let's rock. We got Papa Cohen in the house. Jay Cohen, the father of GC over here, checking in with us. It's a family affair. We got Marie Rockoff from Scottsdale, Arizona, checking in. Good to have you, Marie. We got Eddie Harris from Hotlanta. Eddie, good to have you back in the house as well. We got the ringmaster,
Andrew Barnhill.
Drew Barnhill, checking in with a good day all. Who else? We got Kranti Atluri. It's a new name, GC.
That is a long-time client, Kranti. So nice to hear from you. I'm so glad you're here.
Good to have you in here, Kranti. We got Deborah Schwartz, my karaoke witness, Deborah Schwartz, coming to witness the show today. And like we like to say, if you're watching on YouTube right now, that's awesome. Love having you here. If you are like Kevin, listening to us on the podcast, phenomenal. We love you too. But the best way to do it is to go to NYAIS.com and join us live here on a Tuesday or Thursday and meet the community, right? Like meet everybody face to face, make a new friend, be part of something special like Kevin is doing today. Kevin, can you tell us a little bit about your investing journey to kick us off?
Yeah, well, as you mentioned, I started out in tech sales. I'm still in tech sales, but I'll call it in the latter phases of tech sales. And I don't know, a couple of years back in 2020, I started to say, hey, this working towards a magic number, which I could never actually fully define. I had to go figure out something about this whole cash flow thing. And Gregg, my understanding is you're one of the first Fortune Builder students. I came to you guys through Fortune Builders. So I signed up with Fortune Builders, went to them, talked about cash flow. They did the right thing at the time, and they put me in a pure cash flow community, which turned out to be Kansas City.
Mm-hmm.
Bought a few properties there, but I kind of learned pretty quickly. I should have been clearer with them that for me, I found out cash flow is not the only thing. I've listened to your show a lot, and I've also realized the cash flow isn't that much different, but the property appreciation, the rental appreciation, and all that in other markets are different. So I bought my next 4 properties with you guys. It's been a great experience, and hope to be continuing it.
Kevin, that is just so amazing to hear about your journey. And, you know, when we started the show 3 years ago, you know, not a lot of people thought like you, and we didn't hear a lot of stories like that, but I think we're hearing these stories more and more. What can you say? What was that trigger moment for you where you started to think beyond just cash flow? What really spoke to you?
Well, I happened to start investing right during COVID when real estate prices were going through the roof.
Mm-hmm.
I actually happened to buy a property here in the Boston area for my daughter that she rented. And I started to see the appreciation side pretty darn quickly. And my kids are involved in the rental thing. I saw the rental thing, appreciation thing, and I'm just like, kind of made sense. So when I went my next one, I said, let's try it. Diversification was big. So I said, move to an appreciation market, and I think I'll stay.
Love that. And Kevin, how many? So right now, currently, I know that you've got 4 with JWB. You still got those properties in KC. What's your kind of overall portfolio? What are you holding these days?
I have those 7, and as I mentioned, I purchased one for my daughter, which I since moved to her. So that was in and out of the portfolio pretty quick, but it did its job. And my hope is to start moving more towards it. But right now, that's the portfolio.
Cool. And I love it. And beyond that, 401k, do you have other kind of like things that you mess around? Are you a crypto guy? Like, do you got other things you're messing around with?
So my biggest thing, I think it's in the ROI tool out there, was diversification. So I've got a lot out there, and I kind of dip my toes into real estate. I'm there, but over time I might move some more of it that way. But at the moment, the portfolio is kind of spread into just about everything you can do.
It's really interesting, especially, in today's investing environment. I'm really curious how folks are deciding between what percentage of their investment portfolio should be in stocks, what percentage should be in bonds, what percentage should be in alternative assets like real estate. Do you have any, a set asset allocation plan, and maybe has that changed over the last year or two? Can you give us any insight into that?
I don't have a formal number plan. I kind of started and said, let me try it out and see if it worked, and it continues to get more. I would say my plan is probably new money move towards real estate, so that the percentages will change as it goes there. But the asset allocation I do have in other investments, just the way the general economy you talk about it works, I think it's good to be in quite a few different asset classes, but that just happens to be my humble opinion.
Yeah, well, I agree with you. It's nice. It's nice for real estate in this case to have a seat at the table. It's not like it has to be the whole thing, but there's so many good things about the portfolio you've built in real estate and beyond, right? Our clients who have had success that just warrant a seat at the table in the investment portfolio.
I was hoping you'd go there, GC, because we talk a lot about, this idea of we push real estate hard, but I know that that's your perspective, right? It's like seat at the table. You deposition all these other things because it's so obvious that real estate should have a seat at the table. But at the end of the day, it's not supposed to be the table. It's supposed to just be one part of it because it's so attractive, right?
Well, it can be the table for some. Like for me, it's almost the majority. It is the majority. It's almost all of the table for me. But that's not to say that all of my investments are rental properties, right? I own a real estate business. I have rental properties. I do private lending. There's other forms of investing in real estate. So, I think pushing beyond just what this allocation needs to be, people say 60-40, they say stocks and bonds should be the asset allocation. That's the old way of doing it. Really, if you think about it, it's like 60% equities and 40% debt instruments. And you can have those in real estate. You can have those in whatever. And so, if you happen to have a large, amount of knowledge and experience in one area, well, then you can get equities, you can get debt instruments in real estate. Maybe that's your whole portfolio, like mine is, or not, so it's moving beyond just kind of the old, maybe antiquated ways of building the portfolio is more of what I'm pushing.
No, I did actually through Fortune Builders. You might be familiar with the guy, Andy Tanner, and the Cash Flow Academy. I think you guys interviewed him.
We did.
I did get involved in that and invested time. It pays off, but I will tell you, it doesn't hit that keyword you guys hit as passive. It's pretty darn active business. And for that reason, I tailed back on it.
All right. Makes a lot of sense. We got Matthew Edwards in the chat saying that his wife and him stopped diversifying several years ago, moved everything into real estate, have not regretted that move, Matthew. It's bold and good for you, man. But right now we are going to test our guest investor chops here because we are going to go magically whisked away to the great north for the property of the week in 1359 Ottawa Ave, Jacksonville, Florida, 32210. we've got a purchase price of $270,000, a monthly rent of $1,623, a 3-bedroom, 2-bathroom, 2.5 bathroom footprint, 1,547 square foot. It is a new construction that's finished. Average duration of resident stay that is expected to be 4.5 years. This, what we've been talking about just now, this best-in-class appreciation rate of 4.6%. And of course, the key ingredient here, what we're all actually investing for, this IRR 14.77%, which is currently bolstered by the 10K buyer incentive package that JWB has in place. But GC, what do you love about this property?
No, Pablo, I thought you would never ask. But since you did, I'll tell you what I love about this property here on Ottawa Avenue. Number one, the IRR is super, super close to 15%. We haven't topped the 15% mark for IRR. This might be the closest one. So anytime we have an IRR that is ever so close to 15%, it's something that should really perk your interest, right? We're in an environment now where investors don't have a lot of options to preserve their capital or to keep up with inflation. And when you see an asset here that has consistently performed over decades and has an estimated return on investment, the internal rate of return of close to 15%, that's something that should really, that should make your ears and your eyes take notice here. So love that. Of course, that's bolstered by the incentive package. Quick note on that incentive package is ending on March 31st. So today is what, the 9th? So, you got 3 weeks or so to take advantage of that. If you're a newer client, it might take 2 or 3 weeks to onboard you the right way because we're not going to rush it. And so if you're a newer client and you're thinking about making an investment, now is the right time to get that call scheduled. And if you're a current client and you want to add this property to your portfolio, of course, reach out to the team and we generally can put you into your next investment property a little bit quicker. But either way, it's coming soon. So please take notice of that. Beyond that, I want to teach you guys a little bit about how we do rent escalations. For this property, it is already rented, which is fantastic. If you were in the call on Tuesday, the quarterly call, thank you all for being there. We had over 110 folks on the call, which was our highest attendance in over a year, maybe over 2 years. So that was a lot of fun. But we talked a lot about rents and we talked a lot about rent escalations. And so I wanted to bring you into how we exactly do that. We do have a system for how we do rent escalations at JWB. So for this property, you can see the rent is $1,623 per month. For properties that are under a certain amount, we raise the rent through rent escalations a certain amount. And then when they hit a certain threshold, we raise it a little bit higher. So this is how we achieve between 4 to 6% rent escalations every year, which is better than what we tell you we're going to do on the pro formas, but is a huge benefit to your overall returns on investment. So for everybody's knowledge here, when there's a property that has a rent of $1,300 or less, when we have a rent escalation, which is in the second year, that rent's going to go up $50. When that property has a rent between $1,300 and $1,799, that rent in the second year is going to go up $75. And then when we have a property that has a rent of $1,800 in the second year, that rent of $1,800 or more, that rent is going to go up $100. And so we build this right into the leases. Again, this is better than what's on your pro formas because we like to underpromise and overdeliver. But this is one major way that we're able to increase your returns on investment, continue to gain that positive cash flow, just like Kevin was talking about. That's what initially brought him to this asset class. And it's signed, sealed, and delivered based on that rent and that lease that is signed day one. So for this property, you can see it's right in the middle there between $1,300 and $1,799. So in the second year of this lease, the rent goes up $75 a month, which is great for the owner. And you know what? In an environment like we are facing with rents going up over time, this is good by the resident too, because that's what rents will be at that time period in the market. And now they know in advance and they can plan for it. So I love rent escalations. And this is a great example of how, the client who picks this property up will benefit from it.
Yeah, GC, and these rent escalators, this is automatic, right? Because you're in a long-term lease. This is just happening year to next year within the same lease. This is not renewal and jacking up someone's rent. This is just like an automatic thing that investors we can count on, right?
100%. Yeah, this is openly talked about and described all the way through the process of the new resident selecting the home, choosing to work with JWB, signing up for a long-term lease. And so they're fully made aware of this when they sign up day one for renting that home.
Got it. Got it. Kevin, you've purchased 8 homes at this point, right? Including that one that you got for your daughter. You look at these things, you talked about it, right? You were kind of in a buying cycle, but now you're thinking about a couple of other things. But like when you look at this property evaluation, you're looking at this sheet, where does your eye first go as somebody that's evaluating these deals?
Well, I think like everybody's pointed out, the first place is the IRR, which is in today's market, pretty good thing. But the other thing I notice here is, one, it's a new home. And I do, after being there, prefer the new construction just from kind of being able to count on the numbers more, meaning the maintenance, because you guys have built it for that reason, the maintenance will be down, the insurance will be lower. The insurance likes it lower. And then the last thing is the average duration of a resident stay. Love to understand more about how that's actually determined, but those are great things.
Yeah, we can jump right into that. It's probably simpler than you think, right? We know when residents sign up for a lease, and then we know when residents move out. And so we track the duration, the number of months or years that a resident stays on average. And
so that's across all, not just this property, but across all.
Yes, exactly. Okay. That is our number across our entire portfolio. Yep. Of course, this one was just rented recently I don't have it in front of me, but a few months ago. So that average duration of resident stays across our entire portfolio, and likely what this one will achieve.
Part of the data flywheel, right, GC? We've got a shout out to Tara, who is the mother of the flywheel, but the aggregation of all your almost 5,000 data points of homes being rented in the area that look like that, have a similar type of resident, and this is how you expect it to perform over a full market cycle, right? Like you rent for 2 to 3 years, and then this house is rented for 2 years. You know that you statistically have a 70% rate of renewal for rentals, which puts you at this idea that your portfolio performs like this, right? 4.5 years is the average stay. I would love to ask Kevin, there was a question in the chat, right? You said you look at the IRR first, and I'm trying to find it. I'm on one screen today, so it's a little harder for me. But we had Nurkita Kausholi. Nurkita, hopefully I'm pronouncing your name correctly. Let me know, because you're a new name. Welcome to the community. Nurkita's asking, what is IRR? Kevin, can you explain how you think of IRR?
Overall, it's similar to, what's my overall return going to be over a period of time is how I look at it. And I know the spreadsheet, I usually don't look at the PowerPoint version. I look at the spreadsheet version, and it evolves over time, what my IRR, but it's basically what am I putting into it and what am I going to expect in return against that money.
Well done.
Pretty simply said. GC, what do you have to say about that?
Yeah, I just think, there was a time and place where we didn't talk about IRRs in our show, within the community all that much. And just to see Kevin just step up and knock it out of the park like that is, I think it just shows the savvy and sophisticated nature of our clients and Kevin. So great job there, man. The only thing I would add on to that is your internal rate of return is a form of calculating your return on investment, but it's critical when you're evaluating a project like a real estate investment to understand internal rate of return. And the reality is, most turnkey property providers, most real estate agents out there simply don't understand it, and therefore can't help you evaluate your investment correctly. The reason why it's so important in real estate is because when you're evaluating this investment, your money comes back to you in different amounts at different times. And what internal rate of return allows you to do is to take those different amounts that come back to you at different times. Like, for example, if you had a whole bunch of money that came back to you year one, that would be worth more to you than if that same amount of money came back to you, but it took 10 years to get back to you. Internal rate of return helps to understand what is the rate of return over all of those years, given different timing of the cash flows coming back to you and different amounts of the cash flows coming back to you. So it's something that is super important to understand. It's a little bit scary right off the bat, But as you get into investments like real estate or even buying companies or running a company, that's how big decisions are made to put large amounts of capital out that come back to you at different moments and different amounts.
Got it. We got a couple of good follow-up questions here from some newer members of the community. I love this. Matthew Edwards asks, do you tip? Actually, you know what? I'm going to stick with the IRR question real quick. Gerald Schwartz. Gerald, new name. Welcome to the community, man. If expenses are listed, wouldn't that affect the IRR?
If expenses are listed, would that affect the IRR? Absolutely. It would affect the IRR. And so, Gerard, there's a more detailed spreadsheet that is available to you, so you can go and see, or we may even bring up if you want, Pablo. I'm not sure which direction you want to take. Yeah.
How'd you know?
That's the one.
There we go. There we go. So this is actually what drives the internal rate of return. And as you can see here, there's a whole lot of numbers, which is part of the reason I don't show it on the show, because we all tend to get overwhelmed with numbers. But all these numbers take into account the expenses that the property has on a monthly level, even periodic expenses that happen not every single month, but happen over the course of time. And so all of those expenses are included in that IRR calculation that we present to you.
There you go. And this is the spreadsheet that Kevin was talking about. You can get this at jwbinventory.com. You can download it and you can fiddle with it as much as your heart's content. Mess around all you want. So very good resource. Actually, Kevin, we were talking right before the show. You're like, this is a robust spreadsheet that you like, right?
I loved it. I mean, I look at this and say, this is a free tool that you guys provide. I've seen it from other providers. I've even watched you guys develop it over time. I mean, you keep adding more and more numbers, but when you look at, the PowerPoint, it gives you something, but this gives you the trust and confidence, in each of the numbers. You've thought through insurance, you've thought through taxes, you've thought through vacancy, you've thought through, the turns. The one thing I tweak on it is I go in and basically say the vacancy and the turns happen, whenever you guys pick, so it'd be 4.5 years at this point. Every 4.5 years, you'd have a bit of a turn cost, but overall, this is a powerful tool that I think helps make a good decision.
Really cool to hear. And I'd love to hear your experience knowing that you've invested with other providers, and I'm sure you've seen a whole bunch of different evaluations. What's your experience? Do you see that other providers follow the same format with what they provide for their evaluations? Do you see them leave things out? What do you see?
Well, so when I first came in through Fortune Builders, they focused a lot on cap rate. I don't know if everybody's familiar with that, but that's the operating income over the price you pay, which makes a lot of logical sense to me. But quite frankly, when you're looking cash flow, you're looking internal rate of return makes more sense to me. I don't know if cap rate's more for multifamily, for whatever, but I've seen a lot of them focus on cap rate, which is, I guess it's a good metric, but to me, this is a tool that ties to what my personal objectives are. And They don't provide, I don't know, the one thing I love is your numbers. I mean, with one property, I learned is, when I had an older property, the insurance came back a lot higher. I think that the rates were going through the roof at that point.
Right.
But other than that, then the numbers are pretty much right on.
Yeah.
Yeah. Do you see, I hear cash on cash return, I hear cap rate, and then we always talk IRR. I always have a hard time kind of explaining that stuff. Can you give a quick breakdown for my friend who doesn't know about as much real estate as I do, asking for a friend?
I love your friend. Your friend's awesome. He always asks the best questions. Yeah, absolutely. So cap rate is more of a term that's used in the commercial world, but really can be used for any asset that produces income. And what cap rate is trying to understand is, how much income am I receiving for the amount of capital I put into it? And where cap rate is really useful is it does not count any sort of financing. So, when you're putting an evaluation together and you're assuming that there's financing in place, if you put really advantageous financing terms on that spreadsheet, you can really make your investment look super good from an IRR perspective, right? So if you're super aggressive at getting the very best terms that are out there, you can make an investment that maybe so look really good just by manipulating the financing terms. And That's why people use cap rate, because there's no financing terms in cap rate. It's assuming you're putting all of your cash into the investment. It's just a really easy way to compare apples to apples. Now, the downside of cap rate, it does not calculate all 5 profit centers, and it doesn't take into account leverage when calculating all 5 profit centers. And so it is a helpful tool, but it is slightly myopic. It's a tool that you should know, and it is helpful, but you got to speak internal rate of return as well, because internal rate of return fully captures the value of all 5 profit centers. And then, assuming you look and you use realistic financing terms, it gives you an overall perspective of how hard your money is actually working, assuming you're using other people's money. So both of them are helpful, and using both of them will give you the complete picture.
Got it. We just mentioned 5 profit centers. Kevin, you've been watching the show. You're an educated investor. Do you want to give a crack at explaining the 5 profit centers as quickly as you can?
Oh man, I didn't know we were coming here for a test. Okay,
You don't have to do it. I just assume that you
we'll go with cash flow, mortgage pay down, appreciation. Then I've got the inflation protection. Which one did I miss?
Did you happen to see? I don't even know if we've done the Karate Kid press.
Oh, taxes.
There you go.
There you go.
The tax savings. That's the one. That's the one most people don't really think of, because it has the word tax in it.
It's that time of year.
That's true.
I was about to ask if it's something that seasonally you might be thinking about. Yeah. So, I like to, just to kind of boil it down, right? If we're talking about these like cap rate things and how much things are returning in cash, we talk a lot about the show on the different benefits of the rental property class, and how by financing something, you get leverage that over time, when it appreciates, you get extra appreciation, and you have these other things where the debt pay down, where your resident's paying down your loan, you're accruing equity throughout that, the tax savings that you can achieve through both things that you're paying into and also other things that you don't have to pay into, that gets you tax savings. And that bigger picture has become very, very real to our community. So I just wanted to share that with anybody, since I know we got some new community members in the house. And speaking of new community members, Matthew Edwards has a question here. GC, this one's for you. Do you typically write up a lease agreement for 2 or 3 years right out of the gate, or are they just written for a year most of the time?
Great question. And I love this, just new influence and new folks coming in. These questions are just fantastic. So Matthew, thanks for being here. We are very big proponents of long-term leases, because long-term leases lead to long-term resident stays, and that's how you win. And so we only sign 2 and 3 year leases. And so that lease right off the bat, all through the process of helping a new resident find their home, a new JWB home to rent with us, purely right off the bat describe, here, we are here to help long-term resident stays. We want you to stay with us forever. Something along those lines is the discussion. And we signed 2 and 3 year leases right off the bat.
Hey, when you were telling me a little bit about your experience in KC, was it also a long-term lease the first year, or is that practice something you've seen elsewhere?
No, this is where you get your marketing clips out of, right? Because they're not that vertical integration, Greg, that you talk about. And yeah, I've personally witnessed, there's a benefit for them to do a lease every year. There's a benefit for them to take property maintenance costs and put money on top of them and not spend the time trying to bill it back to the resident. There's a benefit in terms of having stock of something in inventory. I was sharing with Pablo right up in front. I had earlier in the year in Kansas City, I had a tenant there. The heat went out and a $400 part in the HVAC system broke, and they couldn't find the part. And it's January. So I had to replace the entire heating system, which really kills, So there are benefits to, as you're saying, having your objectives aligned, right? And then they don't do the long-term lease, which is huge. I've had more turns. That's why I look to that, 4.5, if you can do 4.5 years on average, there's a lot of value there.
It's just really well said. And I just appreciate you sharing your story. I feel like, I've been, preaching from the mountaintops about long-term leases for folks, but there's nothing like somebody who has lived it. And
Yeah.
the reason I'm such a big proponent of it is because I lived it too. For the first 40 rental properties that I bought, before JWB became vertically integrated, before we started our own property management company many, many years ago, I outsourced my own properties. And what I was told is that you could only sign 1-year leases. So,
Yeah.
Kevin, I was in your shoes many moons ago, and I was frustrated. And I talked about how I had more property turn costs because of 1-year leases, because residents didn't stay. And then I had more fees from the property manager every time. And I also just felt like their goals weren't aligned with mine. And I couldn't exactly put my finger on every single time, but I just felt like it was more of a competing interest rather than true alignment. And, it's just such a simple thing. Like, I don't understand why people fight it so much in the real estate world, in the property management world. I sort of understand it because I understand how the money works, and property managers won't make as much money if they do it. But, we all know if we have been in the shoes of somebody owning rental properties, which most of the people in this community have, if you've ever, paid a mortgage payment when somebody hasn't been in your home, if you've ever had somebody leave and you know that you have to fix the house up afterwards, if you've ever had to pay a new tenant placement fee, that simply avoiding those would be awesome. So simply avoiding them means signing 2-year leases and 3-year leases and focusing on renewals. But a very, very small percentage of property management outfits actually do that.
And then I also you guys build it for these turns that you don't have to spend. So when I had the turns, it wasn't clean the rugs. We cleaned the rugs, didn't work out, but you end up replacing them and you put the LVP flooring down. And it just, you just start to realize that if you work from the very beginning and buy something built for a tenant, have a good tenant attitude, pay attention to costs that are the one-time costs, that's when your value comes back.
You said
Also, Shannon Baker's my contact there.
Touchdown maker.
She's done a great job communicating, telling me what's going on. And she's also done a great job. Tenant goes out there and has their own problems. I won't go into the details of it, but it's amazing how much you guys are able to differentiate for what's a tenant cost versus what's a investor cost. And because you're not taking a fee on top, I think it really helps.
That's awesome. My one request, Kevin, can you start calling her the touchdown maker when you talk to Shannon?
Yeah.
She's developed quite a nickname here around the office, courtesy of all of you out there. So she is just fantastic. And I'm so glad that you're giving her a shout out. She just cares so much as our entire client service team does. So it's really awesome to hear your feedback.
I was telling Pablo exactly 1 year ago today, I came to Jacksonville the first time to see my properties after I'd purchased them all. And I went and Shannon took me on a tour March 9th last year. And it's a good thing to go see the properties. I didn't get a chance to go on the thing you guys just had this year, but I tried to line it up with the TPC Sawgrass event, which I did. And then it turned out raining, so that part didn't work.
Oh, that's right. Yeah, last year was tough for TPC. We've got that going on. But I remember last year, the weather was bad. This year, I think it's going to be really great. So We'll have you next time down for the tour. Maybe we'll line that up with a nice golfing event as well.
Yep.
Kevin, you know what I'm super curious about that we haven't spoken about yet, right? Like, I know I teed you up there for a nice marketing line. This is out of left field. You just said that you are well diversified, right? You had an aha moment of getting into real estate and you've enjoyed the experience. And you just mentioned this idea that moving forward, you're going to continue to diversify into real estate, right? Like, new money is going to continue to flow this way. And you also said you're a couple years away from retirement, right? Like, you're pretty close to retiring. And that part of it is something that we don't hear often, right? Most people, when Gregg and I are presenting in a room, they're like, oh, I wish I would have started this earlier. Since I'm so close to retiring, not for me. What makes this, in this time of your life, why more real estate versus other options?
I mean, it really boils, again, you're going to get it into the marketing stuff, but it boils down to the 5 profit centers, right? It's like, most of the time I've been focused on capital appreciation in the markets and working to try and do that. But to have something that keeps you from drawing down your nest egg and have something that cash flows to a point where you can get cash flow and hit financial independence with that, That seems to me to be perfect, right? So you make enough money passively to pay for your daily living expenses, where I want to get to. And Greg, I was sharing with Pablo earlier, my biggest problem right now in terms of doing that is the loans that I did get are, I originally was planning, say, pay those off, and therefore your cash flow goes really high. But it's pretty hard to say I'm going to go pay off a 3.25 rate loan.
Oh my
So
goodness.
you have to give me some advice on that one. But that, there's that balance. But no, that's the reason, is it's really, you get cash flow plus appreciation plus something that you can bury in for a very long period of time, to grow.
What a good problem to have, Kevin.
Yeah.
What a great problem to have, that the debt that you have on these properties is so incredible because you took advantage of the debt market, using other people's money at a time that it's probably the best it'll be. I can't imagine it getting back down to that level again. So I'm with you. It's going to be hard to pay those things off when you understand the financial ramifications of that. You're borrowing money at 3% when inflation is 6%. So you're making money on the debt that you're borrowing, even if nothing else goes well on your investment. So yeah, I'm with you, man. I know you want the cash flow, but you're going to get to your financial goals quicker. You just keep those debts in there and keep making money on the debt. And it's a beautiful thing.
Kevin, as you go forward, are you thinking that you're going to continue to acquire finance properties? Or are you thinking, because of where you're at in life, you're going to buy with cash, or what's the plan in this stage of your life?
Plan would be a strong word, but the thought process would be much more, to the debt topic, right? To buy with cash, right? So, it seems to make more sense. Especially, one of the things that kept me from doing it, just in that, when you do it with the retirement money, is you just don't get all 5 of those profit centers. So I said, go in with whatever, leave those other ones in an account where you can invest. And that's why I'm saying it's balanced. You invest in something that is not being taxed. You don't have to put it in a house. But when that money becomes free, yeah, I'll have to take a look at what's the smartest thing to do at that point in time. I don't know the answer, but my gut is it would be moving towards buying houses with cash, with after-tax money, with debt on it if debt comes down. But if debt comes down, we have other problems. We'll see.
Yeah, that's interesting. I think it speaks volumes to your education in the asset class, right? Like, so many people, I don't have as many reps as Greg has at it, but in my few reps of like evangelizing this stuff and everything that I've learned in the show, generally people above 50 are like, yeah, but too late for me. And you are still talking about buying with debt. You're still talking about going into the market, going into the real estate market at this point. And I wonder what it is that other people aren't getting that makes them think that, when I'm beyond 40, it's too late for me, kind of thing. I'm still trying to figure that out.
Oh, then I think I shared with you, my son may be watching on YouTube. I don't know, but he's someone I've referred there. He's taking a look at Jacksonville right now as we speak. But, the other nice thing is to put it inside of an LLC, have it, create money for a longer period of time and have that legacy value.
All right. Well, I think this is the moment. This is Gregg's moment to shine here on the show. Gregg, you want me to share the screen here?
You know what? I just pulled it up here, so I think I can take the reins.
All right. Well, so he's put together to show you where your legacy's at right now, man. Let's see it, GC.
All right. So Kevin, it's just incredible to see this journey for you. So what we did is put together some highlights of your journey. We're going to show the full picture of it. We're not only going to show just the best things that have happened to you in your portfolio. We're going to show the full picture, which is what we do every single time we get to have a client like yourself on here. Just curious, do you look at your client ROI report? Is this the first time that you've seen some of this information?
No, I'm one of the strange ones who I do look at this thing. I like this stuff. That's why you do it.
I agree with you, man. I love staying home on a Friday night and just looking at reporting like this. You must be weird like me, right?
And I'll tell you, but the other property managers I've worked with, I haven't seen this tool there.
Yeah, that's great perspective. It's because I haven't seen it either. It takes a lot of work and a lot of, over a decade of putting this tool together for clients to be able to have not just the tool to present, but to have the data flywheel that helps you and helps us. So super cool that you're as passionate about it as me. I always give people a pass. I'm like, it's okay if you haven't seen it, but it's great when we can just lean in and know that you know the stuff too. But there's something that you haven't seen on the report as well. So that's what we're going to be able to go through today. So Kevin, this is what you've built out with the client service team and our sales team as you go through the process of onboarding as a new client. We always want to understand why. And for you, diversification, retirement, leaving a legacy, supplemental income, all the things that you talked about on the show so far today are really the things that drove your decision to come to this asset class. You built a monthly passive income goal of $8,000. We break that down. That would require a total of 8 properties in order to accomplish that. You're at 4, which is incredible. So congratulations. And it looks like your year to achieve that current milestone is 2026, and considering another purchase here sometime in the April timeframe. So wonderful start to the portfolio. And this is exactly what those 4 properties are in your portfolio. So looks like you bought 3 right off the bat here in May of 2021, and then you added your 4th here in February of 2022. It's great to see clients coming in and buying 3 right off the bat because that builds in consistency to the portfolio. What was it about it for you? Was that something you were excited about? Did you already know that 3 is sort of a magic number to get to, or was there maybe some trepidation jumping in and buying 3? What was that for you?
No, 3 was, I bought off on the balance. I kind of knew it. When you have a turn, you'd like to have the other ones balance it out, was good. And then it was also, I know you got your 4 neighborhoods. I tried to spread it out and figure out which neighborhood was best. And again, kind of fit into the diversification thing, but it was one new one, couple of rehabs. It kind of balanced. And the last one was actually more diversification. It was in a kind of a B-class neighborhood, which was why it's a little higher, but kind of tried that out.
Yeah. Well, you got 3 of the 4 neighborhoods right there. You're only missing the south side. So maybe on your next one, you'll get a 32207. And 4 is a great number. 5 is a special number though too. Has the team talked to you about JWB Elite?
I know that you save 1% on the property management costs.
Yeah. So when you get to 5 properties with JWB, you drop your monthly management fees from 10% per month of the rents that are collected down to 9%. And then as you get to 8, a total of 10 properties owned, we drop it again to 8%. So continual goal alignment there and increasing those cash flows and returns for you here. So now what we're going to do is we're going to look at your highest return on investment. This is straight off of your client ROI report, Kevin. So you're probably aware of this. But for those who haven't seen this before, this is that monthly reporting that Kevin and I nerd out on every single month. This return on investment that we're talking about here does not include home price appreciation. We'll save that for the very end here. But this is the property on 9th Avenue. And you can see here, we're beating our return expectations. You can see the annualized lifetime returns, and this doesn't include home price appreciation. We're at 16% when your expected returns were 9.5%. Kevin, was there anything about this property that jumped out to you right off the bat? And you said, hey, listen, I know this is going to be the winner out of the 4.
I forget the very specifics, but it would have been in the top in terms of IRR and the spreadsheet of the ones that, I don't know. I worked with Mike Stewart, and I think I got like 10 options, and this was in the high in the IRR area.
Perfect. And you bought 3 right off the bat, and this was one of those 3. Right. I can assure you, those 3 that you purchased right there, they all had roughly the same IRRs, right? Yeah. This kind of speaks to how we think about rental properties. Now, we love the asset class, but the properties more or less are widgetized, right? It's a production line. We follow the same system every single time so that we can achieve the same results. And then sometimes you're going to have this property on 9th, and that's going to be your winner. But Kevin, as we have you on the show, maybe in 5 years, it may not be the winner. Over time, they all perform the same way. And that's why we're all bought into the long term here. And then we're going to look on the other side, your lowest return on investment, this one on Sunrise Ridge. Okay. We've got an expected annualized return just on the asset on the profit centers, not named home price appreciation, of about 10.5, 10.7, and we're at 6.6. Can you talk about your experience here with this property, which is the lowest returns?
I mean, there's nothing really been negative. They've had a couple of maintenance things, but nothing big. I think it really truly is. The other properties were bought a year earlier. I mean, it didn't get quite the ramp up. The first year is obviously the most expensive. And then I did purposefully buy what's considered a B-class property with the understanding of thinking that it might have less turns over the long term and a little less beating on it by a tenant, which, as I mentioned, in Kansas City, I had a little bit of trouble with. So that was the thinking. We'll find out if it was good thinking.
Well, it's interesting, because, if we're doing our job as a provider, we should account for if there is an increased maintenance cost or a turn cost, we should account for that in the property evaluations. That is included in your IRR expectation. But if we just showed these two properties to somebody who didn't know the numbers behind it and said, which is more likely to have a better return on investment, I would think most people would look at this picture and they would say this one.
Yeah.
Right. Versus your property here on 9th, which is clearly a smaller home. And that's why we need to look beyond the pictures, beyond even the fact that it's new construction. And that's the value of having that, again, that data flywheel, the 17 years of real data that we can use to help and inform. And you're always going to have one that's doing better, and you're always going to have one that's doing worse. And what I tell people is it's very likely those two will switch the next time we get together and have you on the show. All right, Kevin, we're going to take a look at your portfolio overall here. So this is the full picture, and some of this you haven't seen before. Since you started to invest with us about 2 years ago now, we've been able to generate about $7,500 in net rental income. When we talk about cash flow, that's what we've been able to put into your pocket, especially in an environment like the last 2 years. If you think about where your money could have been where it could have been invested, very hard to imagine you would have earned this type of cash flow coming back to you, right? Stock market generally doesn't produce cash flow. Bonds, up until recently, coupons on bonds were so small. So you just weren't going to get that. So you're already winning with your decision to come to this asset class versus the more traditional alternatives. And we haven't even gotten to the other fun profit centers here, tax savings. All right. Kevin, can you talk about what tax savings means to you? Why you love it come tax time every single year?
As a traditional W-2 income earner, it is really nice to be able to see yourself make money, but the IRS see you as losing money, which is, I don't know, it's an amazing thing, but it's actually true all the way down to the tax, you put in there with the whole, depreciation numbers. So I love the fact that you almost look like it is the cash flow is almost tax-free cash flow. It's almost the way you think of a 401k, except you're able to take the money each year. But it's money you get that comes in, that sits on top of your W-2 income, but it doesn't get taxed because the IRS sees you as losing money against it.
That's such a beautiful comparison, comparing what you have created here, which is not in a retirement account, and comparing the benefits that we actually get in retirement accounts, which is not paying taxes on the income that we earn from those retirement account investments. You're able to sort of do that in rental properties, and it's because of this incredible write-off called depreciation from a tax perspective. So that's what we are quantifying here. This is $3,600 in taxes that Kevin did not have to pay. And he would have had to pay that if he earned that same amount of net rental income in some other investment like a bond or in the stock market. So it certainly helps. In about 2 years, he's paid down about $16,500 of principal pay down. This is your resident paying your loan down for you. So in addition to producing positive cash flow for you, they also pay down your debt for you, which is super, super powerful, especially as you hold on for a full market cycle. But then we get to the big one, especially over the last 2 years. Kevin, you're like Pablo, right? You picked about the best time from an appreciation perspective to invest in rental properties. I've never seen home price appreciation like we have over the last 2 years. So congratulations for that. Your portfolio has appreciated to the tune of $210,000 over these 4 properties in just a 2-year span. How does that make you feel?
Fantastic. And I appreciate what you guys do to make it happen.
Well, it started because you chose to do something that most people just never do. Most people stick to the average way of investing. So it's a big credit to you. I also like to show I try to show to enjoy the positives of this, but as Pablo would tell you, I always try to, show the other side, which is we had a really great run up with home price appreciation, But over the long haul, home price appreciation works the same over 10 or 20 year cycles. And so while you got a huge head start with home price appreciation, still when you're doing your planning for what your assets are going to appreciate at over time, over a 10 or 20 year cycle, still keep those historical averages in mind. Over time, it's probably going to get to, call it about 4.5% home price appreciation over the long haul. And that's just how these cycles work. So let's appreciate the positive. You started out with a huge head start, but for all of you who are thinking, oh, did I miss the boat? It's not real, right? Over 10 or 20 year cycles, it all comes back to, call it 4.5%, maybe 5% home price appreciation for the Jacksonville market. And then lastly here, inflation hedging and inflation profiting. We still have a big problem in this country with inflation. Our spending power as an economy is eroding to the tune of 6.4% right now, which is the latest inflation metric. That's the consumer price index. And so if you're thinking about where to put your money, you want to make sure that you beat that number. And inflation or real estate rental properties is a great hedge against inflation, like we've seen over the last 2 years and like we've seen over the last 40 years. And so that is a fifth profit center for you. Kevin, overall, when you put your money with JWB, your expected return on investment was 9.5%. Based on all 5 of these profit centers, your actual return on investment is over 28%. And so we have been able to beat your return expectations. Congratulations, my friend.
That's awesome. And I'd say actually one thing in the inflation hedging thing you didn't do, last week you talked about, I think you said you had like 71 renewals.
Yes.
You guys were good to me. I was 2 of them.
No way.
And of the 2 that were renewed, I mean, I don't know percentage wise, but it was like 25% renewal on the, up on the rent. One of them was like $350 more a month in rent. And I don't even see that in here. So that's fantastic.
Man, that's incredible. I'm so glad you shared that. When we renew leases, other property management companies like to, how can I say this the right way? It's easier for a property management company to rent the property below market rent or renew the property below market rent. But ultimately, that just is an opportunity cost for you as an investor. And so when we renew your leases, we're taking you right up to market rent. And so that's really how you can win. And at the end of the day, if you have a better experience and a better home to rent for the resident than the alternatives out there, they should be happy to renew for market rent. So thanks for sharing that. And you're right, that's just going to continue to bump up those net rental income numbers for you going forward. And then lastly here, Kevin, have you seen this chart before?
Not related to my stuff, but I've seen it done. Yes.
Yeah. This is, I think, I try to help people think beyond cash flows. So when you were talking about moving beyond just a low priced market with better cash flows and seeing all 5 profit centers, this is what I think of and what I want others to think of. It's this pie chart. So at the end of you holding on to this asset for 10 or 20 years, you're going to look back and you're say, all right, well, I did really well in rental properties. How did I do it? And you start to break it down by profit center. And what we see over and over and over again on this show, and one reason I show this every time we get to have a client come on, is I break down their total return on investment by profit center. And what we always see is 60 to 80%, or even more in your case, of your overall return on investment is driven by one profit center, which is not cash flow. It's home price appreciation. And so I'm so glad that you independently saw the light, thinking beyond cash flow, and that helped you move to a growth market like Jacksonville. Because at the end of the day, if you choose a growth market, that can equate to hundreds of thousands of dollars of additional return on investment simply by being in a market that appreciates more than the alternatives. And that's what we see here. And the cool thing is that no matter if I choose a client who started investing in 2006 or 2010 or 2014 or 2021, the pies all look sort of similar, right, Pablo? They all kind of look like that big Pac-Man.
You call it a pie chart. I call it a Pac-Man chart when we're looking at this thing.
So Kevin, you're just doing a great job, my friend. Thank you for the trust that you put in our team, and we're happy to be beating your return on investment expectations. And we'll keep the seat warm for you when you want to come back, and we get to give you another update of how we're able to help you.
Yeah, no, thank you. I appreciate all you've done, and I appreciate you inviting me to the show and showing me the appreciation numbers. I hadn't seen those, so it's nice stuff.
Well, Kevin, it's been great meeting you, man. I got to chat with you a little bit before the show. It's a great story. I love that you are bringing your son along on the journey. You brought, you're making it a family affair, right? You already got your daughter into it. Your son is getting into the family business, if you want to call it,
Yeah.
and also becoming an investor as well at an early age. I think that's just such an incredible advantage to have. So hopefully this appearance on the show is another kind of like validation point that they should be more like their old man,
Yes.
do
There's
do
not a
their
lot of
part of
those,
that. Yeah. And I want to thank the community, right? Like great questions today. I loved having some new folks join in, some great questions that allowed us to clarify through the journey of an investor that has done this stuff and is doing well with this. Really, really interesting conversation, and never goes unnoticed that it's the middle of the workday and you're taking an hour to spend time with us here, connect with each other, ask great questions, get educated, become less and less average as time goes on. So super pumped for Tuesday. We got Not Your Average Insights back. We're talking about what the heck is the Fed doing? Are they freezing out this like BRRRR investors? Is that even viable going forward? What's the risk profile for BRRRRs, however you want to call that? I don't know how we're going to transcribe that piece, but we're going to dive into kind of like some of these zany things that are happening in the Fed and how that's going to affect the active investors as well as passive investors. And we're going to go deep into some headlines. GC, I'll give you final words here.
Yeah, Kevin, you're the man. Super appreciate your time. Love the story. Thank you again for being here. Love the community. Love the new folks in the community. It's been a real pleasure seeing this show just kind of expand week in and week out. So thank you all. And yeah, I'm really fired up for Tuesday, man. We hear a lot of this Burr method. I know the Burr method. That's how I started. So I can share with you the positives and the negatives. And it's a much different ball game right now doing the Burr method than it was 1 year ago. So be able to give you guys some insight there and certainly some things to watch out for if that is what you are doing.
All right. Another great POT dubs. Kevin, thanks again. And remember, if you want to be like Kevin, you want to diversify, you want to invest in real estate, lend a life, we want your kids to follow your footsteps. You just can't think like an average investor. See y'all next week.
See you.
Thank you.